Welcome back to the Clara CFO Group channel. Today we're going to talk about equity. And equity is a part of the balance sheet of your small business. And sometimes people they'll look at a balance sheet and they might understand the assets section, they might understand the liabilities, but when they get down to equity, which is the bottom section of the balance sheet, it kind of all falls apart. It can look confusing, the terminology is a little bit different, and a lot of times it doesn't seem all that logical. So what we're gonna do today is explain the equity section so that you as a small business owner can feel like you understand the balance sheet completely when you're looking at it, and you understand kind of the intricacies and the ups and downs of the equity section. So if that sounds good, please stay tuned. If you're not already subscribed to the channel, I would love to have you here. This is a place that we learn about business finances. And so this video is an example of learning a little bit more so that you can be empowered to have a more financially successful business. So if that sounds good, make sure you are subscribed and also like this video if it is helpful. Okay, so equity. Equity is kind of the part of the business that's sort of the leftover. I'll start there. So assets minus liabilities equals equity. So equity kind of becomes this sort of leftover section, but it's really not. It's part of the double entry bookkeeping system. And so when we make a contribution to the assets, it has to come from somewhere. So a lot of times it comes from equity, or it could potentially come from liabilities. But I'm not going to get into the intricacies of double entry bookkeeping. What I'm going to do is I'm going to show you some real equity sections from real financials. I'm going to just show you what it looks like. I took screenshots from QuickBooks, and I'm going to walk you through what the different components of equity might be, and it's probably something you'll be seeing in your business. And then I'm going to show you a good example of an equity section that's nice and cleaned up and easy to read. And then I'm going to show you one that hasn't been cleaned up, and yours might look a little like this if you don't understand equity, or maybe your bookkeeper's been taking care of it for you, and then after this video you'll know if it's in good shape or bad shape. But I'm also going to teach you how to fix it if for some reason you don't have an equity section that has been quote unquote cleaned up. Okay, so you'll understand more as we keep going here. But what we're going to do now is we're going to go ahead and hop into a screen share so I can show you and walk you through the different components of the equity section. Let's go. So here we are, and this is a good example of an equity section, and I'm going to talk you through this. So the first part here is called opening balance equity. And what this means is this is the business basically started with a certain amount of equity. And what that means is maybe the owner was bringing in to the business things that they already had. So maybe they had already purchased a laptop that they're going to use for business, or maybe they had went ahead and spent some money of their own personal money to get the business license. Maybe they, purchased some software to get going before they had their books completely set up, or maybe they just funded a bank account. Maybe the business owner came in with $5,000 and maybe a few office supplies, and that is kind of the opening balance equity. So in that situation, they would have debited the assets that they were bringing in and then credited this opening balance equity, and that's that double entry bookkeeping. So this opening balance equity is it's never going to change. It's like when you started the business, what was the equity? And this is kind of a cool number to keep track of because you can go back and look. So like this business now is making, total equity is close to $80,000, and they're making $94,000 in net income so far this year. And all of that started with a $5,000 investment to get going. So opening balance equity can be like an interesting number to look at, but really you don't need to pay much attention to it because it doesn't change. It will always be the same. Next, we have an owner's distribution. And owner's distribution is something that a lot of us are going to run into because most of us as small business owners, we're going to be what's called like a pass-through entity. And what that means is that we make money in the business and we can distribute it to ourselves as our personal income because the business has earned the money. And so that income flows through to our personal income our personal tax returns, and then the IRS allows us to distribute that profit to ourselves in the form of an owner's distribution. So the owner's distribution line item in your equity section should be negative because it means that you've been taking money out of the business. So that's where that negative number comes in. And then this should be showing everything that you've taken out of the business for the current year. Okay, so that's what you can think of when you see that. Now you might see this called owner's draw. Distribution, draw, same thing, okay? And then you might also see this called shareholders distribution or shareholders draw. Same thing as well, just if you are a sole proprietor or an LLC, you don't have shares in your business, so it's just kind of a terminology thing. But owner's distribution, like I said, if you have a sole proprietor, a LLC, or if you're an LLC taxed as an S Corp, you're probably going to be taking some sorts of regular distributions from the business to help supplement your income. And if you're an LLC or taxed as a sole proprietor or a sole proprietor, all of your income is going to be showing up here from what you've taken as a distribution. Some people think that that shows up on the profit and loss statement, but that's not true. It shows up here. So here's where you can see your cumulative amount of how much you've taken over time. So in this situation, this has been properly cleaned up. And so this just shows what the owner's taken for the current year to date, okay? And so let's go down to owner's distribution taxes. This is what I would say is best practice for small businesses because, like I was talking about, owners have these pass-through entities, or owners that have pass-through entities, they have to pay taxes on the earnings of the business, but they have to pay it from their personal because that income from the business is kind of going to their personal taxes. It's their personal tax liability. So what we do is we draw money from the business, pay it to our personal, and then the personal side pays the taxes. Okay, so what I like to do here is I like to separate the owner's distributions that are just for like regular pay and then the owner's distributions that are for taxes. And the really great part of that is then you can see, how much you've already paid into taxes in one nice little line item sitting on your balance sheet. So I think it's best practice. And so this is obviously, this is somebody that we've advised to do that for. So this is, again, good example of the equity section. So the next we get down to retained earnings. So retained earnings here, this is a number that is kind of what's left over at the end of the day. The end of the year, and it changes and it will build cumulatively over time. So what this number literally represents, it's what are the earnings of the business after distributions and after the owner has taken what they need, what is retained in the business. So in this situation, this whole business for the lifetime of the business has retained almost $50,000. Okay, so some of that you're going to see in the cash on hand, some of that you're going to see in potentially some assets on the books, but that's like what the business has accumulated over time. So if you see retained earnings that it's in the negative, that actually means that the owners have potentially used more money than the business has actually brought in, which might happen in situations where your business is like heavily leveraged with debt. You might be getting debt from other places, but actually spending all that money or potentially taking some of it home. So a negative retained earnings would not be a positive thing. You want to see a positive number here for your retained earnings for the overall health of your business. And then we get into net income. So net income is kind of like the current retained earnings. Like this retained earnings number would be accurate as of the last day of the previous year. And then kind of the net income is sort of our year-to-date retained earnings. Minus, it's kind of like net income minus the distributions would be our retained earnings for the current year. So without getting into too much like detail on that, the net income is especially this is a cash basis business. So this is all the cash that's come in, and then minus the distributions that the owner has taken on that is what's still remaining in the business. And so at the end of the year, net income will be closed out and the owner's distribution numbers will be closed out, and the difference will go into the retained earnings amount. Okay, so you can understand why this might be a little bit confusing, but feel free to leave any comments or questions in the comment section below, because I think that, we need to understand this like the back of our hand, basically. If you are a business owner and you have a balance sheet, you want to understand this. So here's an example of an equity section that needs a little bit of cleanup here. We have zero opening balance equity. That's fine. I don't care that there's zero there. That just means that they probably didn't record something. This business is probably very old. But what is not right is we have this draw that's almost $800,000 and retained earnings that's $1.03 million. And I don't like the fact that those numbers are very large because it's triggering to me that I don't think that this draw is from this current year. When we're looking at the balance sheet, we want to see that draw being current. It's being like, what is the current year? How much has the business owner taken from the business? And so what this means is that they've actually never closed out retained earnings, or they've never closed out their draw to retained earnings. So what you would do in this situation is you would go to the balance as of 12/31 of the previous year, December 31st of the previous year. You would find the balance of the draw. So maybe it's 750,000, let's say. And you would create a journal entry to correct it. And I'm going to show you what the journal entry will look like in just a second. But what that'll do is it will make retained earnings look much lower, and then it will make the draw look much lower as well, because basically we need to net those two together anyway. So, okay. So, because at the end of the day, all of this sums up to total equity at 309. So like we're kind of falsely inflating in some ways with these big numbers in our equity section, and it's not really all that helpful. So let's just like bring them down, net them together, and that's an annual entry that happens every single year. So it's kind of part of the closing process for the financials. Okay. And so you'll also notice on this, they don't have a separate line item for taxes either. So that's another recommendation I would make to this business owner, that we have a draw for just compensation or just distributions to the owner, and then also a distribution for taxes. All right. So here's an example of closing out the equity section. So this is a different equity section. It's actually from the good example that I have. This is kind of, I believe this is as of May 31st, what we're looking at here. And so we took that same company and then pulled the balance sheet as of 12/31/2022. So we could see what are the balances at the end of the year of the owner's distribution and the owner's distribution taxes accounts. And these two, for the 60,000 and the 11,000, these two need to be closed out. They need to be closed out to retained earnings. So what you'll see is you will see this journal entry that we make. So keep these numbers in mind here, 60,000 and 11. When we go down here, we'll close these things out. So we take retained earnings, we debit it, and then it's like zeroing out the owner's distribution and the owner's taxes. So that would be a credit entry. So when we do that, it closes out those numbers to retained earnings. Okay, so you can see here to close out the distributions to retained earnings, basically we're trying to say, okay, that money that we took out can't be retained earnings because we took it out. So we're trying to lower that retained earnings balance. So we do this on the first day of the following year. So we close out 12/31. This is what our balances look like. And then the next day, we can backdate the journal entry. We're going to close out the owner's distribution, the owner's taxes, and we're going to offset that to retained earnings. And then all of the net income that happens from that year goes into retained earnings. So this like net income balance of 118,032 would be increasing retained earnings. And then this, minus the distributions that we took, which decreases retained earnings. All right, so that's everything I need to show for these equity sections. So hopefully that's helpful. Hopefully it helps you understand a little bit better when you're looking at your own balance sheet. And you can let me know if you have any questions, put them in the comment section below. And if this video was helpful to you, please give it a thumbs up. I know equity can be confusing, but hopefully we kind of demystified it a little bit for you today. All right, well, thank you so much for being here, and we'll see you soon. Bye.